Good morning, everybody, and welcome back to Beat the Bell, presented by Kane Capital. Excited to have you all with us on this beautiful Wednesday morning. It is a shorter trading week, but we are still getting the job done. Missed you guys on Monday. Of course, the market was closed, so were we, but it's back into action. So the market has pulled back over the past couple of days, but we've seen some fun trading, especially in individual names. Tech continues to look super strong. There have been short squeezes left and right. And it's been a pretty fun trading environment and a good way to start the summer. Also, today is, of course, the last day of May, so let's make it a strong one. All right, bringing in our panel, starting with Money Mander. Money Mander, good morning.
Good morning. You got it. Happy hump day. Let's do this strong.
All right, Diamond Trades, good morning.
Good morning, Alejandro. I hope everybody enjoyed the long weekend. Excited to get after it.
And Ramsay Rippers, good morning to you. All right. Fed forecast and economic calendar. What do we got?
Yeah, let's do it. Let's start with the economic calendar for the rest of the week. So Monday, obviously, markets were closed for Memorial Day. Yesterday, we didn't have a ton of news, but we do have some high-impact news to come into the end of the week. So today, we've got JOLTS at 10. Tomorrow, ISM Manufacturing at 10, and then NFP Friday at 8:30. So some higher impact news to close out the week. The market edged out a green close to start the shortened week of trading after news came over the weekend. Then a tentative deal had been struck to raise the debt ceiling. The intraday session was choppy, with tech continuing to show relative strength yesterday, outperforming, and energy and industrials continued to underperform. So we had the NASDAQ close higher yesterday on a show of strength, and really the Dow industrials have just been relatively weak for several weeks now, and we've just seen that theme continue into this week. The little bit of news that we did get so far this week was the Case-Shiller Home Price Index for the month of March. That index reports with a 2-month lag. So house prices fell 1.1% on a year-over-year basis in the month of March versus 1.6% expectations. This is the first negative print on the Case-Shiller Home Price Index since about 2012. So definitely seeing home prices start to come down after that aggressive squeeze late last year. If you guys remember, that was like one of the main things that was sort of contributing to the narrative around inflation, is that shelter prices are on the rise. And so now that we're seeing shelter prices fall, it's really something that, that's an argument that's been made by those who believe that inflation is going to fall off towards the end of the year, that housing prices are going to start to come down. And at least on a year-over-year basis, that's what we're seeing. But it is important to note that on a month-over-month basis, the increase was actually about a 1.5% increase in the home chiller prices month over month versus 0.4% expected. And if you look at the month over month trend, we've really been sort of trending higher ever since last summer, right? So on a year-over-year basis, the number is coming down, likely because the comps from last year are so high that it makes sense that when you look at that year-over-year number, it's going to come down substantially because of the elevated comparables from last year this time. But when you look at the month-over-month number and you see this this steady uptrend in the month-over-month home prices, I think that it's going to be potentially a factor going forward for, like we said, if people are looking at this as something that could potentially help inflation to get down to the Fed's 2% target. If we continue to see this upward pressure on home prices, naturally that decrease is going to slow down, right? And it may not be as much help as we thought. It's definitely something that we want to pay attention to going forward. And I think the month-over-month numbers really make sense as well with the strength in the labor market that we've seen really over the past year. So let's go ahead and move into Fed Fund futures. So the market is now pricing at about a 59.6% chance of a 25 basis point hike at the June meeting, the June FOMC meeting, which comes in about 2 months here. That's up about 2.4% from just a 23.9% probability just about a month ago. Ryan, I want you to play that clip from about a month ago. It's funny that you talk about the pricing at, what did you say it was, 80% of a pause next meeting? I mean, we just did on the episode immediately following the First Republic getting taken over by the FDIC, and sort of like in the middle of last week, so that Wednesday to Thursday, when it seemed like the sky was falling again when it comes to regional banks. I think that the probability that Friday was at like a 99%. Basically, the market's pricing in a lock of a pause. And we talked about this yesterday, right? How like there's never such thing as a lock.
Yeah, I agree. And I think they left the door open for data to change, but you want to see it changing. And so I think the longer that we come in with a 5% print, the 0.4, 0.5 month over month, the more it shows that the Fed isn't quite getting their objective done.
So that clip was filmed on May 10th. And Ryan, if you want to pull up the call sheet chart here. So as you guys can see on this website, Call Sheet, which is essentially an online marketplace where you can make bets on anything from the government shutdown to the president's approval rating at the end of the year. A bet on a 25 basis point interest rate increase at the June meeting would have cost you about 11 cents for a dollar back. That was back on, May 11th when the market for this essentially bottomed the day after our clip. And then today that bet would cost you about 62 cents for a dollar back. So more or less a 463% increase on the Call Sheet website. Had you taken that alpha from your favorite Fed forecast, Mander, what do you think?
Yeah, we were all over this. Kind of sick we didn't take any of those on the bet of 5.25 and above. But I think exactly what we said back then still holds true, right? You still have inflation stuck at 5%. Even right after it happened, I think it was really getting priced in because of the fallout of those three banks that happened, which definitely was significant. But even a week later, Jerome Powell came out and said the financial system remains extremely resilient and we're not too concerned about this. Inflation still remains our main target. So I think for a while there, the markets were getting a little overzealous pricing in this pause. I think right now is probably more realistic. It's like a 3/5 for a hike, 2/5 chance of a no hike, because they did say, if you read the minutes released from the last meeting, it was about a 50-50 split of in favor of a pause, in favor of a hike. And so I think that's probably about right. It should be somewhere close to a 50-50 in favor of pause or hike coming into this meeting. But 97 to 3% was definitely not, it was ridiculous there.
Ridiculous.
Let's take this over real quick. One thing I saw yesterday that I wanted to cover today, because I think it's rather interesting and just shows the historic rally we've seen in tech here. QQQ versus IWM and the NASDAQ 100 versus the Russell 2000 has now recently crossed 8 on the index ratio, meaning the NASDAQ 100 has a market cap and is valued 8 times higher than the Russell 2000, which is the highest level we've seen since the peak of the dot-com bubble. And so really with so much concentration and outperformance going into these highest weighted names in the NASDAQ, which obviously, and it's no coincidence, are at the forefront of this AI rally, the NASDAQ has really outpaced every single index year to date significantly, but has now reached historic outperformance to the Russell 2000 that back then in the dot-com bubble signaled the decade's last tech implosion. And so I want to get your 2 cents quick, and then I have my 2 cents on, do you think this flow diversifies into small caps and the Russell 2000 now just outperforms to the upside, or do you think QQQ kind of bursts this bubble and it underperforms to the downside and sells a little bit more significantly than small caps?
I think we talked about this yesterday, to be fair. I think you could see a situation where long Russell and short NASDAQ makes sense. I mean, just with the spread between the two right now, right? Where and the mindset there is, I'm long the Russell, short the NASDAQ, expecting that going forward, if they both go up, the Russell will outperform. The NASDAQ has already broken out. The Russell has sort of been trading in this range for really well over like 3, 4, 5 months at this point. If we can get continuation to the upside in the broader markets, both will go up. I'll lose on my NASDAQ short, but the Russell will outperform, cover my losses. Same thing on the downside. If I'm short tech and short long the Russell, if I'm going to lose money on my Russell long if the market goes down, if the broader market as a whole comes down, but the NASDAQ should come down more than the Russell, since the NASDAQ has outperformed so far, and it's got more room to the downside, essentially, would be your thought there. So I mean, I honestly don't hate the idea at all.
No, I think that's a great spread trade, at least ahead to the downside. I'm in the same boat. I think the Russell just outperforms to the upside, and I'll show you exactly here why. If we look at real yields, this is really the one thing that I think is vastly different from where we were at in 2000 when this was at an 8 ratio, and even in 08, right? In both of those instances, you had real yields on treasuries very positive. So in 2000, you had the 10-year real yield at 4%. It was yielding around 6.5. Inflation was at 2.5. And then in 2008, it was still over 2% with a 4.5 yield. And again, like a 2.5% inflation. So still real yielding positive, right? That is going to incentivize investors. If you're feeling a little shaky on equities, if you think they're kind of outperformed like in 2000 and they're due for a pullback, and obviously they got a very significant pullback in 2000, you had somewhere else to park cash that still made money. But right now, with inflation so high, the 10-year is actually real yielding a minus 1% annual basis, and cash is losing 5% annually. So really, I just think with inflation so high, and it's clearly going to be sticky with the strength in the labor market, because unemployment, we'll see Friday. So far, it's lower than it was 500 basis points ago when they started hiking. If you're an investor, you're kind of left with one option. Cash is losing money. Treasuries are losing money. You might as well go ahead and take the risk on this, kind of decade-long booming sector, even though they're so overvalued, right? You at least are taking a chance on growth somewhere in the market, and you have a chance of making money. Everything else, like your opportunity cost here, the next best alternative is guaranteeing you lose money. So I think most people are saying I'd rather take the chance on these blue chips they've been growing for 20 years. You have AI coming out, and I think that's really what's kind of fueling this fire here.
Who was that that put like 80% of their fund in Qs the other day? Did somebody do that?
Yeah, Noble, ticker NOPE, I believe it's a Noble fund.
Top.
It's supposed to be diversified through markets and sectors globally. They just put 80% of the fund into QQQ.
Top right there. That'll wrap it up for us here at Fed Forecast. Let's pass it back to Alejandro.
That's my type of fun, fellas. I love it. Load them up. Make the big bets. All right. Let's talk about the system, and then we're going to talk about some ES levels. So what we're looking at here is a buy signal that we got. We got the rally on Friday. So we broke back above the 50 SMA on the 30-minute chart as well as the hourly chart. And now, as we can see, yesterday we chopped around a little bit, pulled back a little bit. And this morning, we're also pulling back, likely towards this 50 SMA. We'll see where we open up. But for as long as we're trading above the 250 SMAs, the bulls are in control. Okay, so that's the system chart. Take a mental picture. You guys all have it on your own charts by now. But I want to share some ES levels because there's something important that's taking place here in the pre-market. So give me a second here, and I will shift over. All right. So right now we're testing key support 41.93. The reason I say that this is an important area is because if we lose this, I'm of the belief that we're going to come back down and test this 41.75, which was Friday's breakout. So we've been in a steady downtrend. This is an hourly chart. We've been in a steady downtrend for a couple days now. The pops have been very short-lived. Bulls have not been able to get direct continuation after Friday's rally. And the market's simply doing what it's supposed to do. And we talked about this when we got the rally last week and the pullback last week. Excuse me, the rally 2 weeks ago and the pullback last week, how bulls, what they want to see is a back test of that breakout area in order to see continuation. So this is what's required, okay? But if we lose this 41.93, 41.75, I believe will serve as a magnet level. In between that area is the rational market low, which is important to note for those that have this indicator up on their chart. You guys know that price tends to stay in between the rational market high and rational market low. It's not necessarily support or resistance, but it is a good guide, and I do use it in my trading. So the only thing standing in between 41.93 and 41.75 is that rational market low. But again, I would not be surprised if we come down and we test this breakout area and then price does its thing there, likely chops around before making a decision of whether or not Friday was a breakout or a false or failed breakout. Okay, so something that's very important there to watch going into the remainder of the week. All right, now over to Ramsay Rippers for Bet the Bell. For the system, I'm going to pass it over now to Ramsay Rippers for Bet the Bell. Good morning.
Good morning, guys. All right, guys, let's get right into it. Ryan, pull up the stats. Constant shakeup after constant shakeup within the stats.
No surprise. Said it was going to happen. Nobody should be surprised.
I don't know how much those stats make sense. Can you go back?
I'm looking at them too. They don't make sense to me either.
How are we both at 61% if we have the same amount of losses? Math error? Or?
Don't ask me. I'm not in charge of it.
All right, we'll have
You
to
got
check
to
that
producer
out.
Ryan in.
We'll have to check that out after the close.
But it looks as if you
Oh, it rounds. Got it. Okay. All right. 2 games back. It's fine. Let's go. Let's get after it.
All right, let's do it. With that being said, green or red today. Indices slightly down. Hondo, what do you got?
Give me a second. I'm gonna go red today.
Mander.
Consulting the magic 8-ball there or what?
Yeah.
I'm taking red as well. It looks like the recession trade is back, at least for the day. Yields are down, bonds getting bought, commodities sold. So I think this red holds.
Noah.
Notice how much time he took? Definitely like asking ChatGPT or something like since the start of this.
Dude, you guys are
magical.
nuts. I had to pull up the chart.
Since the start of this little magical run he's had.
Christ.
Unreal.
Unbelievable.
I'm gonna go red as well. I like it just with where we are on the chart, where we are in the week. We do have news today at 10, so I mean, who knows? But I'll go red.
Gotcha. All right, next question. We're going to get into SPY. We got a what do you guys see happening first? 450 or 390, basically equidistant from where we're trading at right now. We have a gap to fill on the downside at 395 and that 495 or 395, and that 450 area is supply resistance from back in February, March, April of 2022. We haven't been at that level since. The market did break over 4,200, tried to sustain. Looks like we're going to open below that this morning. This is a little bit of a macro time frame question. We got some time. We'll keep track of it. What do you guys see, Diamond? 450 or 390?
390. I mean, 390 is within the range that we were just trading in. So even like Alejandro was saying, if this was like a false breakout type deal and we come back into the range, 390 is like makes a lot of sense. I think for 450, we would have to like actively break out and push higher. I'm not saying that we can't do that, but I mean, 390 seems a little bit more likely. So yeah, I'll go 390.
Mander.
Yeah, 390 as well. I think this would just need a lot more breadth and investment going into outside of just these 10 stocks to get us to 450 here. So I think a pullback to 390 makes sense.
Oh, no.
I'm going with 450. So Rocket Scooter has been showing us that market makers are positionally bullish going into the summer. And as long as that remains the case, I'm going to continue.
We got a little freeze. All right, I believe that. So Honda went 450. Let's get into our last question, and I was only really going to ask Diamond and Mander about this. Ryan, pull up the tweet from UW. Am I frozen too for you guys?
No, you're good.
No, you're good. He doesn't have the tweet.
Oh,
just
okay.
read it out.
All right. Anyways, credit card debt for the United States Americans is now over $1 trillion in February of this year previously. So about 4 months ago, we were at like 920 billion. As of today, we're at $1 trillion, more than a third. A couple stats, fun facts. More than a third of Americans now have more credit card debt than emergency savings, which is the highest on record. Gen Z is raking up credit card debt faster than any other generation, and Americans are not paying off their credit card debt. Obviously, high inflation has fueled some of this debt. Millions are living paycheck to paycheck. I believe some of it has to kind of do as well with just the psychological factor of not actually spending real money, if you want to call it, and getting attached to that sort of concept, spending money that you don't have. Mander, what kind of effects do you see this taking place and moving into the future as far as just day-to-day American life and even the Federal Reserve, if you want to talk about rates moving forward?
Yeah, sure. So we've been watching this. It's actually a really good segue because me and Diamond have been covering this as we hit like 850, 900, really this whole way. And I just saw, so it was up 17% year over year, which is obviously well outpacing wage inflation. That's almost like triple wage inflation. So I think this is definitely going to become an issue with delinquencies. The question really is when, but when it does, it clearly is going to be an issue. That is $1 trillion of outstanding debt on the financial system that if, a significant portion of it doesn't get paid is going to put the banks at a big disadvantage here. So I guess we'll see, right? APRs are at 20-year highs. They just crossed 21% on average for credit card interest rates. So I guess we'll see. It is a massive issue, though. It's a massive issue because consumers are still, and this is what's really keeping the economy high, and consumers are still consuming at massive rates. But with inflation so high and wage inflation not keeping up with actual inflation, you have a negative real, what's my word here? Diamond, help me out here.
What are you looking for?
Your real income is less, and they're still consuming at the same pace. So we'll see how long they can really string this out, but I don't see this ending well.
I mean, I agree to you to I agree with you to a certain extent. Obviously, you could just continue to rack up credit card debt and not pay it off. The payments are going to become more expensive as interest rates are being elevated, things like that. At the end of the day, what likely happens though, right, is whoever owns this credit card debt, if people just decide not to pay it one day, gets bailed out by the Fed printing $1 trillion. That's how it gets solved. I feel like that's how it seems like everything gets solved. So I that's sort of what I would imagine is going to happen. Should this sort of get out of control and start to spiral. But I mean, it really doesn't appear to have had an impact so far. I mean, if anything, it seems to have had a positive impact, like Mander mentioned, on spending. So, yeah, that's my read.
Yeah, I agree with that because I mean, I'm pretty sure it has been like this since the middle stages, even the early stages of 2022. I think I was looking at the numbers, and we've been in the 900 billion area, if I'm not mistaken.
Yeah, that's what I mean. It doesn't really seem like it's had a negative impact just yet. I mean, theoretically, should it? Yes, but will it? I just don't see it.
Gotcha. All righty, that's going to wrap it up here. We'll pass it back to Hondo.
All right, guys, to close today's show, we're going to finish up with Trade of the Week with Mander, who's got a trade recap.
It's time for America's Trade of the Week.
Now, here's a guy who knows how to trade stocks.
All right, let's take it away. So this was on Friday. Obviously, I think, there was a million trades you could have had that would have qualified for Trade of the Week on a squeeze like we had on Friday. But this one I really liked because I found the lagger, and you guys know lagger trades are my favorite trades. I was watching Qs explode out of the gate. So immediately I'm crossing all my mega caps, and I saw Meta really basing here right at gap fill from the day before, and it hadn't squeezed yet with the rest of the market. So I jumped in the 255s. I actually went a little closer to the money. I probably could have had something ridiculous had I stretched out to 275 and a half or 260 calls, but I went with the 255s here right under $1. You can see I bought these at 935, and the second that 935 candle opened, squeezed 3 points. So I was out half of these over 100% within 5 minutes. And then at that point, you're playing with a house trade, right? Just ran these up as long as the squeeze wanted to continue. I wanted to get out a little early and enjoy my weekend, so I actually cut these around 230 for 533%. Ended up going about 700% into the bell, but I don't think anyone's taking 5 bags and complaining into the long weekend. So that was my trade of the week. Absolute printer.
Awesome trade, and that was one of 5 multi-baggers that you had last week. You were on a tear.
It was one of those days. I was cool. We caught the short on the Tesla and Apple on the one red day we had all week, but a day like Friday, load calls and let them squeeze. That was one of the craziest short squeeze we've seen really all year.
It was a lot of fun. A lot of fun to watch. All right, guys, that's going to do it for Bet the Bell. Beat the Bell. Appreciate you guys tuning in. If you want to trade with us, we'll be live all day in the Kane Capital Discord. You go to kane-capital.com. Excited to get going once again. You can scan the QR code right there as well that Ryan has thrown up. Other than that, have a great rest of your day, everybody. And we will catch you on Friday morning at 8:30 a.m. Eastern time. Have a good one, everybody.